Okay, once again, Francis Hurd at the JSE. Francis, you were telling us about what this oversupply in oil globally is doing to markets. Not looking very good at the moment.
No, again, investors are fretting about the price of oil and it's low again. That was after last week. There was some hope, talk of Russia getting together with the oil cartel OPEC, possibly cutting production. That would have helped some countries that are exporters of oil, but that's faded and we're down again. Let's take a look at how markets are reacting. Basically a miserable day across the world, and we're in line with that. Starting in Europe, the FTSE in London down 1.7%, the CAC down almost 2%, the DAX in Germany 1.3%. At home here, the JSE All-Share Index down 1.4%, industrials in the red, financials down quite substantially, 2.5% lower at the moment. Looking at the miners now, the big resources stocks are down 2.6%, and we'll talk about BHP in a moment. The gold index down 1.3%, platinum also in the red, slumping 1.2%. Looking at the actual commodity prices, gold at $1,124 an ounce. Platinum, $860. Oil, there you have it, $30.74 a barrel. That's what's causing major concern at the moment. And our rand, unfortunately, it hasn't been able to push below 16 rand to the dollar again, weakening once more today, 16.05 to the dollar, 23.10 to the pound, 17.50 to the euro. And there we have a look at how we are faring against our BRICS fellow nations. All right, let's get some more analysis. We're coming to you live from the JSE in Sandton. I'm joined by Robbie P. From Vunani Capital. Great to have you with us, Robbie. You were saying it's not only oil. Basically, that rally we saw after the Reserve Bank raised interest rates is gone. What's weighing on the markets today?
Well, look, I think it's a combination of many things. You know, after the rout we saw in January, it was really no surprise having a look at how markets reacted yesterday or behaved yesterday after a massive rally last Thursday and Friday. There was a bit of a feeling of window dressing, that they couldn't let January end off on such a bad note, and we actually saw a bit of an over-recovery on the last 2 days of the month. So no surprise really that we see a little bit of profit taking going into the first 2 days of February really. Weighing on the markets, you know, some poor Chinese manufacturing data. Investors not really sure how to price this slowing China in, and they need to get used to this new two-paced growth, you know, slowing down in manufacturing and increasing in sort of service-orientated growth.
That's what China wants to do anyway, rely more on its consumer markets. So.
Well, exactly right. I mean, the population is massive, and they do need to focus their growth there, given that the commodity space is so flooded and demand is just not there. So that obviously weighs on our market. As an emerging market, you know, any BRIC nation is going to feel the pinch, especially when you're commodity driven.
All right, what is the role playing of this low oil price again? And then we saw BP coming out, and I guess the results bring into sharp relief the effect of the low oil price.
Well, you know, when you see a massive sell-off like this, many investors are conned in the first bounce that, you know, we call a relief rally, and you start hearing, oh, is this the new oil price? Look, the fact of the matter is that we've had Iran come back online now. They're spending billions and billions of dollars. There is no slowing down in the production of oil, because if oil prices are depressed, the producers have to produce more in order to maintain their revenues and their turnover. So the outlook for oil still remains very gloomy. I wouldn't be surprised to see it really make its way down to the $20 a barrel level. You know, pundits are saying that we should reach an equilibrium between supply and demand in the US roughly the latter part of this year.
This is interesting because our petrol price is actually going up slightly tomorrow, and I think the AA was warning we should be careful. Unfortunately, the weaker rand has stopped us benefiting fully from the lower oil prices, and I think the AA was saying if oil ticks up, then we're really in trouble because we have the weak rand and a higher oil price. But I'm interested in what you're saying, that actually no, it could go much lower.
It really could go much lower, and that is a threat. I mean, the AA has made a valid point. and there has been an under-recovery on the oil price versus the rand. The only thing that might cap us a little bit is that we're all aware that we're going into an interest rate hike cycle, and we're expecting 4 rate hikes this year, which should defend the rand a little bit against the majors as we try and fight the strong dollar. So that might fend off a lot of the hits that we're planning to take. But yes, if the rand maintains these levels and the oil price does find support, I think motorists are going to be hit very hard.
In trouble. Okay, let's look at some of the individual stocks. If you look behind you, FirstRand, the big loser right now, down more than 5%. What's weighing on the banks, do you think?
Look, again, I don't think there's a lot weighing on the banks today. The banks have had a stellar run over the last 4 days. In reality, the markets have just snapped a 4-day winning streak. FirstRand was actually one of the outperforming banks. So this is kind of a combination between profit taking, starting the new month, and also just the rand not managing to breach that 16. But it looks like 16 might just be a level to hang on to for a while.
Moody's yesterday saying the opposite to what everybody else was saying, that the banks would benefit from the higher interest rates. Moody's was saying, in fact, more people could default. Do you think there could be concerns yet that we could have bad loans rising and things like that? Well,
look, I think that it is very likely. But what happens at the same time is that banks' lending criteria also have to be adjusted and amended. So what happens is that instead of increasing the default pool, you probably end up with less of a buyer pool. So all this credit buying sort of shrinks. And the whole purpose of this interest rate hike cycle is to fight inflation. So I think a lot of credit-driven consumers are just not going to have access to any more money.
Yeah, be careful if you're trying to buy a house. BHP Billiton, also you were talking about the downgrade there. We haven't focused on the mines for a change for a while. What does this all point to?
Yeah, it's funny. When you see a little resource rally, all of a sudden mines are the flavor of the day. Unfortunately, the fact remains that a strong dollar really depresses commodities in the resource space. We've seen stocks like Anglo American, Billiton, trying to trim down, trying to cut costs, restructure. We had results out from Kumba earlier, also cost cutting, trimming, restructuring. The guys are really feeling the pinch. Now, Billiton did receive a credit downgrade from S&P today. Billiton has got the strongest credit rating in the sector, and there is a credit watch out on the company from S&P, and they're hoping to get out of that by their next set of results. But as I say, the guy's feeling the pinch. Billiton down over 4% today.
Yeah, a lot of red on the board. Those credit rating agencies causing problems again. Thank you for your analysis, Robbie P. from Vunani Capital. And that's a wrap. We were coming to you live from the JSE. Ciao for now.